do a quick sound check just to make sure the audio is coming through at your end. If you can hear me okay, if you can just drop a yes or a Y into the questions box, that would be marvelous. Fantastic. Okay, thank you very much. So it looks like the sound is coming through, so we shall make a start. Okay, good evening everybody and welcome to Oanda. My name's Simon Clark and I'll be presenting the webinar this evening. Now this evening's webinar is part 2 of the Forward Thinking Traders program. In this part is part of the price action mastery, which is sort of understanding the techniques to read price action. Now the webinar this evening will run for approximately a couple of hours. Because we're on for a couple of hours this evening, what I'll do is we'll aim to have a break about halfway through just so that we can get some refreshments and make sure that we're comfortable for sitting through the second part. Now I like to try and make these sessions as interactive as possible, so if you've got questions as we go through on the particular topics or slides that we're discussing, then please feel free just to pop those questions into the questions box and I'll gladly cover those as I go. If I do miss any questions, then I will come back to them at the end, and of course if you have any more generalized questions on trading, then please feel free to pop those into the questions box at the end, and I'll try and cover those and help you out as much as I can. Now before we get started, we have got 2 risk disclaimers which I need to make you aware of this evening. The first one here is from Oanda. It reads, leverage trading carries a high degree of risk. Since you could lose some or all of your deposited funds, you should carefully consider your financial objectives, level of experience and appetite for such risk prior to entering this market. Most importantly, do not invest money that you are not in a position to lose. Now this presentation is for general information purposes only and does not take into account your personal circumstances. It's not investment advice or an inducement to trade Forex. Now examples shown are for illustrative purposes only and may not reflect current prices or offers from Oanda. You're solely responsible for determining whether Forex trading or a particular transaction is suitable for you and seeking professional advice as required. So we also have another disclaimer, this time from Trade with Precision. So please just take a few moments to read through this one. This one's quite a bit longer. So I'll just give you a few moments to take a check through here. In brief, what we're saying here is that Trade with Precision and myself, we're not financial or investment advisors. We don't recommend any particular security of any kind. Any securities that we mention throughout the webinar this evening are purely cited for illustrative and educational purposes only. Investing in the financial markets is risky and it is possible to lose money. So, please make sure that you understand the risks and seek advice where required. So please make sure that you're comfortable with these terms before continuing on the webinar this evening. Okay, so before we get into the main content this evening, I just want to give you a quick introduction to the 2 organizations that we represent here on the webinar. So first of all, of course, we've got Oanda. Now, Oanda was incorporated in 1996 and was one of the first companies to offer fully automated online currency trading. Now, the company has grown since those days to a stage where today they handle more than 1 million queries a day. Now, in 2001, they launched FX Trade, which is a state-of-the-art trading platform which enables retail clients and also institution clients alike with a state-of-the-art trading platform from which to transact business. Now they've also won many awards for their services over the years, from within the industry and also client services alike, such as best trade execution provider, best retail trading platform, and best mobile trading platform as well. Now then we have Trade with Precision. Now, Trade with Precision was founded by head trader Nick McDonald. He formed the company back in 2006. Basically, at the time, he was living in London. He was a private trader. He had developed his own trading methods and his own trading strategies and methodologies, and he was just doing very well. And at the time, his broker could see that he was doing very well and approached him and asked him if he would be prepared to share his techniques and share his knowledge with their other clients which weren't doing so well in the markets. To cut a long story short, he did. He did that and he enjoyed it. And at that time, Trade with Precision was born. Now the company's sort of grown since then via many sort of corporate partnerships, such as we have here with Oanda. Now we teamed up with Oanda in 2013 to provide education programs for their clients as well. So we specialize, or we're a company that's a little bit different to a normal company, because when we are a small team of traders, we're spread all over the world. So I'm based in the UK here, England. We've got people in the US, people in Europe, Australia, and New Zealand as well. So we're pretty much spread across all the continents. So we're a small team of private traders. We all trade for a living. We all trade exactly the same trading strategies, and we might trade sort of slightly different markets, but we all trade a bunch of markets which we all use the same strategies on. Now what we do is we just share our trading strategies through our education programs. So you see that these are the strategies that we use to trade our accounts day in and day out. So let's take a look at the agenda that we're going to cover today. So we're going to pick up from where we left off in part 1 last week, and we're going to delve deeper into the forces that drives price. Now we're going to take a further development and look at the framework for interpretation of price movement. We'll build layer upon layer of technical tools and start combining these different levels of technical analysis together as we go. This is exactly how we go about building a trading decision. What we're trying to do is we're trying to look at what's actually happening in price action, what the underlying momentum is in the market, and building a decision across multiple different time frames using different types of technical analysis to build a predictability as to what we think is going to happen next, and then to be able to position ourselves to take advantage of that. So today's price action mastery components are going to be moving averages, using these as patterns and zones, and we'll combine these with price trends. Now we don't use moving averages in any kind of conventional way, so we're not going to be using these in the traditional ways that moving averages were designed for, but where they are very useful tools that can be used in some modern, unconventional ways to be able to give the trader a very good feeling of what's happening behind the markets, the sort of psychology behind the markets. So we're going to take a look at some of these techniques of how to use moving averages this evening. We'll also look at support and resistance, and what we class as true support and true resistance. Now, support and resistance lines, again, are nothing new when it comes to technical analysis, but we look at these with a fresh approach to finding and interpreting these levels. Now, these are very, very powerful sort of structures within the markets, and we use these support and resistance levels to identify structures that we can then build trading decisions around, and also build perceptions of what is going to happen next in price action. We'll also look at candles and candlesticks. Now, candlesticks again is a very common tool, technical analysis tool for traders to use. But we're not going to be too concerned about what the names are and what the different patterns are of candles. What we tend to do is look at really what's happening behind price, really the important information that we can gauge from candles. So we'll look at whether they're bullish, whether they're bearish, or whether they're indecisive. We'll look at all of the information that a candle can give us rather than focusing on the names and the patterns of them. So let's move on and take a look at the first one, which is moving averages, patterns and zones. Now, price doesn't move in straight lines in the markets. If it did, it would make life nice and easy for us as traders. But instead, price tends to move in waves. And these waves can provide us, traders, with opportunities to join a prevailing trend as price pulls back to levels of what we call equilibrium or fair value. Now, moving averages really help us to highlight this equilibrium zone within the charts. Moving averages can also help us to smooth out the short-term fluctuations in price and help us to highlight the trends themselves. Now, what we use is we just use 4 simple moving averages. We've got a 200 period moving average, which is the longer term moving average, which we always color in our charts as green. We have a medium term moving average, which we always color as red. And then we have 2 shorter term moving averages. So we have the 20 period, which is in blue, and the 10 period, which is in black. Now, the reason we always color them the same is because if they get all crossed over and the markets are not as clean cut and as clear as a trend as what we have here, we always know which moving average is which. So it's always good to use a common set of colors, no matter which, whether you use our colors or your own. Now, there's different types of moving averages that you can use. You can use the sort of typical ones are what's known as a simple moving average or an exponential moving average. Now, all it is that the exponential moving average is a slightly different calculation in the calculation of that moving average. But to be perfectly honest, with the way that we use moving averages, it really doesn't matter which one you use. You can use simple or exponential because we use them in a technique that works with both of them. And the difference between the levels of those different moving averages are going to be pretty insignificant. So let's look at the first technique here that we use moving averages for. The first thing that we use them for is moving average geometry. Now, correct moving average geometry is an important aspect to note in combination with a strong price action trend. So what we look for is we look for all the moving averages to be in alignment with the current price action. So we can see here in this diagram here, this piece of price action, we can see that we've got a nice clear trend. We've got a very strong trend in this market with all the consistent higher highs and higher lows within price action. We've also got all of our moving averages there. Let me get my pointer there all the time so it doesn't keep disappearing. We've got all of our moving averages here in the correct order. So we've got our 10 above our 20, above our 50, and above the 200. And they're all sort of trending in the same direction as price action, at a similar angle to price as well. There's nice space in between the moving averages, as we can see. They're not crossing over all the time and flipping over from one side to the other. They're all staying nice and steadily in the same pattern and with nice space flowing in between them. And we sort of give that a term as that moving averages are just fanning. They've got nice geometry and they're just fanning. Now, when we find markets that have got a good strong trend with moving averages fanning like this with nice geometry on them, it just adds an extra layer of confirmation to finding the strongest trends within the markets. So let's look at how we use moving averages for a long setup. Now, a long setup, you'll recall, is a setup where we're looking for prices to be rising. Now, what we look for is for the averages to be in consecutive order, with the quickest on top and the slowest on the bottom. For example, the 10 period would be above the 20 period, the 20 period would be above the 50 period above the 200. Now, that's not necessarily essential, but it's nice to have. Now, this signals that an uptrend is in progress based upon the averages, but we must also compare the higher highs and the higher lows within price action as well. So the trend and the ebbs and the flows of the price action is still important, as we discussed in part 1. Now, the 200 period moving average, if that's in the correct order, it just means that the current trend is more established and has a longer term momentum behind it. But as you'll see, it's not always essential that it is there. So what we've got here is a long example of two charts here. So we've got an optimal example here where we've got the 10 period above the 20 period, above the 50 period here in red, and we've also got the 200 period as well. So we've got nice clear trend, higher highs, higher lows in price. We've got all of the moving averages flowing nicely in the right order with nice, what we call geometry between them. So nice fanning action, nice space in between those moving averages. Now, what we also have over here is we call it there not perfect, but okay. This setup here is that we've still got a nice trend in the market. So we've got nice clear series of higher highs and higher lows in an uptrend. But this trend is not quite as mature as the one over here on the left-hand side. So this is a much younger trend. And we can see that we've got our 10 period above our 20, above our 50, which is the red one, but the 200 hasn't turned around in the right position just yet. Now this is okay, but it's not perfect. Now, just a couple of questions that are coming through. Let me just check these. Okay, so questions around what time frames would we use these techniques on? I mean, first of all, these techniques that we're going to be discussing this evening, all of these techniques are universal across all time frames. We use these strategies for trading on all different markets and all different time frames. If I can give you an example, I like to trade a lot of, well, I've got about 70 markets that I like to trade on a regular basis. So I've got probably about 50 Forex pairs, currency pairs. I trade a lot of the indices as well. So a lot of the big indices like the US indices, like the S&P 500, the NASDAQ, the Dow Jones, Euro stocks, and things like this, and also the German DAX as well. So I like to trade a lot of those types of indices. I like to trade metals, so gold, silver, platinum, and a lot of currency, a lot of commodities rather as well. So soybeans is one of my favorites, soybean meal, sort of wheat, rice, crude, all those types of commodities as well are popular commodities which I like to try and trade. Now, these markets, I can trade on anything from daily charts right the way down to, on some of these markets, like the S&P 500, for instance, in the day session, I can get right down to 2 and 5 minute time frames. So very, very low time frames, but I'll still be using exactly the same techniques and exactly the same trading strategies. So they are completely time universal and market universal as well. So when we close, well, we're going to talk about when we open and close the positions at a later time, because first of all, what we're going to be doing is talking about the techniques and about how we use the techniques. And what we'll also be talking about later on in the program is we'll give you all of the rules for the trading strategies that we use, and we'll give you specific entry criteria and specific places where we'll take our stops and how we will then look at taking our targets as well. So let's take a look now at a short setup. What we'll be looking for is for the moving averages to be in a consecutive order, with the quickest on the bottom this time and the slowest on the top. So we want the 10 period below the 20 below the 50, and ideally the 50 below the 100, but not necessarily essential. So again, it just indicates a nice downtrend is in progress based upon the averages. And again, we also need to compare the price action, the swings and the ebbs and the flows within the price action itself. So this is not necessarily a replacement for the trend or for the ebbs and the flows of price action, but it actually complements the trend. So having the two together just means that we're trading, or we're looking at, the strongest trends available. So this is what we mean. So for an optimal sort of setup here, we've got clear downtrend in price action, nice clear series of lower highs and lower lows. We've got all the moving averages in the right order. This is our 200 up here, and they're all in the right order, and they're all flowing very, very nicely in the same direction as price action. If we take a look at this other one here, we've also got a clear downtrend. We've got a nice clear series of lower highs and lower lows. We've got, again, all of the moving averages in the right order here, apart from the 200. The 200's almost coming into the right order here, but at this moment in time, this is still a relatively new downtrend, and this is just indicated that the 200 is not quite there just yet. So this is still okay, but it's not quite as strong as this setup that we have over here on the left hand side. Now let's talk about using moving averages, because many traders view moving averages as support and resistance. They might use them as buy and sell signals, which are some of the techniques that moving averages have been used for when moving average lines cross over, for example. Now we don't use any of these techniques, and we don't use those sorts of signals from moving averages. Using moving averages in those types of circumstances, in those type of ways, they tend to be very lagging. In other words, what happens is that moving averages are very slow to give that type of confirmation. So what tends to happen is that they more or less confirm what's already happened in price. So if a moving average crosses over, and a typical buy or sell signal, for instance, traditional signal was if the two moving averages cross over, you would buy the market or you'd sell the market. And of course, because they take quite a bit of time for the moving averages to move, well, the price action's already moved. It's already halfway through its move by the time the moving averages have crossed over. So they're very lagging using them in those traditional techniques. Now, moving averages are dynamic trend lines, though, that can help us to indicate potential buy and sell areas within price. So we combine these with other factors, and you'll find that the techniques that we use to trade the markets will need multiple different levels of technical analysis to build up on each other before we get a setup that is strong enough for us to consider trading. So we need multiple different levels all stacking up at the same time. But having a moving average indicating an area in price where we can then start to look for other opportunities starts to help us. So moving averages, with using them as dynamic trend lines, help to identify these suitable equilibrium areas within price action. Now, moving average zones. So you've now identified a chart with moving averages in the correct order, and the moving averages have got nice geometry on them where they're fanning and they're not crossing over, and they're nicely flowing in the same direction as the trend. The next step is to identify a chart where the price is pulling back into the buy zone or the sell zone. Now, this is just like an essential component of the trend flow trading strategy, and it's a bonus point for the momentum breakout trading strategy. So you'll see when we actually give you, or get to the point where we give you the strategy rules, we actually have points for each of the technical analysis. We'll have essential points which have to be there, and we'll have bonus points. So bonus points are additional elements which, if they're there, that just makes that trade setup that much more stronger. So it's important to understand how to read the technical analysis and how to use it for all of the strategies that we use. Now, the zone that we're talking about here is an area around or very close to the 10 and the 20 period moving average. So you need to use your judgment a little bit here as to what we consider to be close to or around these zones, but it's much easier if I show you here on some charts. So in an uptrend, we class this as a buy zone in an uptrend. So what we're looking for is this zone in between the 10 and the 20 period moving average. We can see that we've colored it here as yellow. So the zone in between the 10 and the 20 period moving average is the zone, it's the buy zone. And we also consider this sort of orange zone, which is just either side of the 10 and the 20 period moving average. We consider this to be the buy zone as well. So it's a zone that's in and around these 10 and 20 period moving average. That's how we consider the buy zone in an uptrend. It's just exactly the opposite in a downtrend. So all we're looking for is this area in between those two moving averages, in and around those moving averages as a sell zone. And you can just see each time the price sort of comes into the zone, it either comes in and tests the top of it, or it comes in between the two moving averages, the market tends to find new momentum and the trend continues. And the same with this downtrend. Each time the market sort of comes into the moving average, it just seems to, or into the zone I should say, it just seems to find new momentum and the trend continues. So what we have here is an example of optimal bullish structure with the moving averages. So what we've got here is a nice clear series of higher highs and higher lows in price actions. We've got a nice trend within the candles, within the market itself. We've got no extremes of buying or selling, so there's no erratic candles here with big wicks on them and sort of large, extra large size candles. So there's no extremes of buying or selling evident here in this piece of price action. No erratic or uncertain behavior, just nice steady buying momentum in the market, nice steady ebbs and flows within price. And you can notice how we've got all of our moving averages now all in the right order. So we've got our 10 period in black, our 20 in blue, 50 in red, and our 200 in green. They're all in the right order, all flowing nicely in the same direction as price action. And you can just notice how price keeps coming back into the zone here, back into the buy zone, finding new momentum, and it continues to make a new high, comes back into the zone again, makes a new high, back into the zone again. You can see how consistent that is. Now this is an ideal market This is the type of thing that we want to look for within the markets. A nice sort of structured trend like this, because that starts to become a lot more predictable when we start to lay other layers of technical analysis over it. So this is just an example here of optimal bearish structure. Again, this is just the opposite. So we've got a clear series of lower highs and lower lows in price, nice clear steady trend with consistent lower highs and lower lows. Our moving averages all in the right order, as we can see here, with all flowing very, very nicely, all fanning very nicely, nice moving average geometry, nice steady selling momentum in the markets. And you can see each time the market sort of comes into the zone, it sells off again and makes a new low, pulls back into the sell zone, sells off again and makes a new low. And you can just see how consistent this is every time. Now, let's take a look at the next technique here that we use for moving averages. Now, we use them to help us gauge overextension within the trend. As you've seen, ideal is to look for a nice smooth, flowing, consistent, predictable trend. So moving averages can help us to identify price action when it's overextended from the trend. So the further that price moves away from the moving averages, the greater the probability that that price action is going to snap back to them. Try and think of price as a bit like an elastic band. So if you were to stretch an elastic band, to its extremes, let one end go, it's going to snap back pretty rapidly to its original position. Now, price tends to react in a rather similar fashion around its moving averages. So the further that price tends to extend away from the moving averages, the quicker it tends to snap back to its original position. So the quicker it tends to retrace back to those moving averages. So if you try and think about price reacting like that around the moving averages, then it can start to give us a bit of predictability or a bit of foresight as to what we think might happen next, especially when the markets are extended from the moving averages. So let's talk about what we mean by overextension. So we can see here with this piece of price action, we can see that once the price moved up here, it became quite extended from the moving averages. We've got all the zones here. We've got all the moving averages in the right order, quite overextended here. The price pulls back into the zone before the trend continues, makes a new move, becomes overextended, pulls back in. At this stage here, price is overextended from the moving averages. So, moving averages is the zone is just down here, price action is right up here. So the expectation is that price is likely to come back to the zone before it continues to make new highs. So that's exactly what happens. Eventually what happens is price pulls back into the moving averages before we then expect the trend to continue. So just using this technique, we don't necessarily expect the trend to change. All we're expecting is that price may pull back into the zone before it continues its next leg of the move. So we've got a little practical here for you, and we've got some various practicals as we go through the session this evening. So take a look at these three charts here and decide what you think is going to be the next move in price. So I'm not talking about the direction of the trend, but what I'm on about is the next move in price action. So take a look at chart A. What do you think is likely to happen here next in chart A? Do you think the next move is likely to be up or down? Take a look at chart B. Do you think the next move is likely to be up or down? And the same with chart C. So I'll give you a few moments just to take a look at this. Drop your answers into the questions box and we'll work through them in just a few moments. So we've got lots of answers coming through. Okay, let's take a look. So I think everyone's saying A is up, 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 up. A is up, A is up, I think everyone is saying that A is up. Some people are saying now A is going to pull down. Okay, looking at this with A, I think most people said that A, the next predicted move, is likely to be up, because what we're looking for here, if we look at, we've got a clear trend to the long side, we've got consistent higher highs and higher lows. Each time price comes back into the zone, it then makes a new move to the long side. It's come back into the zone here, it's made a new move to the long side. Exactly, it's just got to come back into the zone here, it's made a big move to the long side. Now we're just back into the moving averages again. So the next expected move here is for the trend to continue to the long side, in which case it's got to make a new high above the previous high. So at this stage on chart A, we haven't got any indication that this trend is going to change. So we're just expecting the next move to continue in the direction of the trend. So chart B, we've got a nice downtrend here in chart B. Nice consistent lower highs and lower lows. All of our moving averages in the right order as well. Now moving averages are 10 period is here and our 20 is here. So that's where our zone is. And price is here. So it's quite a long way from the moving averages. So the expectation would be that price would pull back into the moving averages before the trend would be continuing to the short side. So that would be the prediction that we would expect for chart B. When we take a look at chart C, now I can see that I've got a mix of answers here for chart C. Some people are saying that it's going to go up, some people saying that it's going to go down. So that's good because there's only two answers. So if we look at chart C, we can see we've got consistent trend here to the downside. So we've got lower highs and lower lows. So we've got a nice downtrend. We've also got our moving averages all flowing in the right order as well. So they're all flowing very nicely. Nice geometry there. Now at this point here, the market has actually been quite overextended from the moving averages. And we can see the pattern of this as price has come down, overextended from the moving averages, retraced into the zone, next a big move away from the moving averages, pulled back into the zone, big pull down away from the moving averages. Next expectation is that we retrace back to the zone and then the trend continues. Now at this moment in time, the market has retraced. I think this is where it's caught some people out. The market has gone up. We've had 3 bars of bullish price action, but we're just coming into that sell zone there. So we're just coming into that equilibrium area where the expectation is that the market will find new momentum and the trend will continue to the short side. This trend is still going to be in a downtrend until it makes a new high above the previous lower high, which is just this area up here. Okay, so let me just check a couple of questions. Okay, so we have also, yeah, so I mean, these candles are bullish. So questions around these candles looking a little bit bullish, and that's quite okay if these candles do look a bit bullish, because what we're expecting is, in the context of a trend, we're expecting price to retrace back into the trend. So it's okay to have upward moves as well as downward moves. So we're going to have counter trend moves within the context of the trend. You know, as I said before, price moves in waves, and that's expected. But what we don't expect is this sort of action to continue forever, just a solid sell-off in a straight line. Okay, so let me get my pointer back there. Okay, so I'd just like to say also that we've also got Tommy from Awanda also on the line now as well. So if you do have any questions related to Awanda that are specific to Awanda, then you can actually ask him directly through the questions box as well, and he will be able to pick those up and he will be able to answer those at the same time. Okay, so let's move on. Right, so the next technique that we're going to look at here is support and resistance, or what we classify as true support and true resistance in price. Now, identifying price support and resistance levels is a critical element of technical analysis. In combination with the trend, it can be extremely powerful. Now, traders are hunters of opportunity. They look for structure in price that will cause price to react in a reliable and quantifiable manner. So this is known as an edge, and an edge that forms the basis of a high probability trading strategy. Now, looking for these support and resistance structures offer the possibility of creating an edge in the markets. So if you understand the concepts of trends in combination with support and resistance correctly, you can create that as the basis of an entire trading strategy around them. So I can't emphasize enough that understanding trends correctly and using price action trends with support and resistance is like the key fundamentals really are here of getting an understanding of what's happening in the markets. So when we talk about trends and support and resistance structures, the first thing that we want to establish is what we mean by support and resistance structures. Now, one thing that we establish first of all is sloping trend lines. Now, the difficulty with sloping trend lines, they do have some uses for some traders, but using them for true support and true resistance structures in the markets become very subjective. So if we take a look at our piece of price action here, we can see that there are a number of potential trend lines that different traders may start to use. So we've got a trend line here, which is A. We've got a trend line here through here, which is B. We've got further trend lines here at C, and also others here, at D. And the trouble is, as a trader, which one do we use? They're very difficult and they're very subjective, because different traders will have different amounts of data on their screens. They'll draw the trend lines in different areas, and where do you buy and where do you sell? The difficulty really with sloping trend lines is that for every new candle that occurs in the market, the trend line, a sloping trend line, changes in value. So they become very, very subjective. So what do we use, or what do we consider to be true support and true resistance? Now, one touch of a level is not support or resistance. Now, these are lower levels within a downtrend, and they don't form any kind of support. In fact, if we take a look at this piece of price action, we're expecting price to break through these levels. You know, the market's made a low here, you know, but because we're in a downtrend, just because the market comes back down to this area again doesn't mean to say that this has now become support, because we're expecting this level to get broken in a downtrend. We get the same thing here. You know, we've got a low, we're expecting price to break through that low because we're in a downtrend. It's exactly the same in an uptrend. You know, just because we're looking at, you know, highs, previous highs in price action, if it's just one test of that level, well, we're expecting price to plow through that because it's going to be an uptrend. If that level has been tested multiple times, then it would be different. But just one test, or the previous high or the previous low in a trend, is not strong enough to be considered as support or resistance. Now, true resistance is when the market has at least two high tests at a level within a tick or two of each other. So, you know, it has to be sort of fairly close to each other. Now, the more touches, the stronger the resistance becomes. And tradable opportunities can sometimes exist on the break of these support and resistance levels in the direction of the prevailing trend. Now, resistance occurs when price has failed to penetrate up through that flat price point, and consequently forms a flat line of price action. Now, once a level of resistance is broken, then it is likely to become support if that level is retested. So that's a little golden rule that is always worthwhile noting, and we'll discuss that in a few minutes. But you can see here on this piece of price action that we've got an uptrend forming here in price. We've got our low, we've got a high, higher low. You know, we've got an uptrend here. Price has come up, it's tested this level a couple of times, tested it a third time before it's breaking through, and the trend has continued. Now, true support is just the opposite. Now, true support is when the market has at least two touches at a specific level within a few ticks of each other. Now, the more touches, the more precise and the stronger the support becomes. Now, once a level of support is broken, then it's likely to become resistance if that level is retested again. And if we take a look at this piece of price action here, you can see, you know, that this market has tested this lower level, you know, a good 3 times before breaking. We've tested it a couple of times here before breaking. We've tested it, you know, 3 times here before breaking and continuing down. So you need at least 2 tests of a level for a level to become true support or true resistance. But the more tests of a level, the stronger the level becomes. Now, this chart shows a combination of both true support and true resistance. Now, both can potentially provide tradable opportunities. Now, when we look at this type of chart, some traders might think, well, they'll fade the high. They'll fade every time the trade of the market comes up to this level. So in other words, they'll, as soon as the market sort of keeps coming up to this resistance level, they'll look at selling opportunities. Likewise, they may look at buying opportunities when a previous level of support has been tested. Now, a break of these levels in the direction of a prevailing trend is always a more preferred approach. There's always a more higher probability when we start to combine the trend analysis and the strength of the trend in combination with our trade direction. Now we can see here, this level of support through here eventually got broken here, and now the market's coming back up to test this level of support and potentially is likely to find resistance here. So if we take a look here at this piece of price action, so this looks a bit of a fairly erratic price action in the context of a downtrend. If we look at it a little bit more closely, we can start to see that there are some levels of previous support here in price. You can see that the market's tested a low here once, it's tested a low here twice, it's broken through. It's tested a low here once, twice, 3 times before breaking through. And you can see this occurring a number of times. Now, we can then, if we take a look at this a little bit more closely, we can also see that these support levels have also acted as resistance. So we can see that as these levels, the markets formed these levels of support in price, and the price is broken through and continued in the direction of the trend, if the price comes back up to those areas, it's often finding resistance there, just helping the trend to continue in its direction. And you can see this happening many, many times within the context of this piece of price action. So if we think about what's actually happening here behind the price action, we can see that we've got, markets coming down, it's testing a level through here, so it's testing it once, testing it twice. So each time it's testing this area, buyers are coming back into the market to push price up. Coming back down, it's retesting it again. Buyers are coming back into the market to push the price back up. It's done exactly the same here until this red candle here. And at this point here, there was no more buyers. So the buyers had run out, which allowed the price to fall straight through that area. So if there's no buyers now above this level, when the market comes back up to this level, guess what? There's no buyers left in the market at this level to be able to take the price higher. So in which case, the market rolls over. So it's simple sort of psychology of what's actually happening behind the price action. You start to see this sort of reaction happening time and time again. Now, flat level breakouts, which is required for one of the trading strategies that we're going to teach through this program. So we call it the momentum breakout strategy, and this is a strategy that we use these flat levels as a breakout. So we'll actually have a trading opportunity that we will look at to take advantage as price breaks through these levels in the context and in the direction of the prevailing trend. Let's take a look at another example here. So we've got a piece of price action here. If we take a little bit more closely, we can see that there's a level through here that the price has come down. It's tested this level once, it's tested it twice, so it's found support here a couple of times. The market's then broken through this level, it's broken through it here, it's come back up, and it's now become resistance. It's moved down, it's come back up, it's retested this level again, it's become resistance again, and it's looking like it's going to become resistance for the third time. So when support is broken, it often becomes resistance if it's retested. And just think, that can add further weight to a trading decision. If we're thinking about trading this market to the short side, then we know that if it's going to come up to a level of potential resistance, then we can actually utilize that information in the context of our strategy. So we've got a bit of a practical here now to help you with your understanding. Before I get there, I just want to check a couple of questions that have been coming through. So, Sar, is there any indicator that you have in both Web and MT4, so that's FX Trade and MT4 trading platform, to fill in the yellow and orange in between the 10 and the 20 period moving average? I'm not sure there is, to be perfectly honest with you, Sar. I think certainly not within the I certainly don't think that there is a standard indicator to do that. Tommy might know a little bit more about that if there is anything, but I would imagine that possibly within MT4 it's possibly codable if you're advanced enough to be able to do that. But if not, it is just that area around those zones that we look for. Okay. So if we take a look here, so this is a screenshot that you could take. You'll find on the webinar up here in the either the top right hand corner or the top left hand corner, I can't remember which, there's normally a little camera icon which you can actually press, and that will take a screenshot of the screen and then put that onto your desktop. So think about what's happening here within price action. So to understand trading, we must understand what's happening in the markets, and more importantly, why it's happening. So try to explain why support becomes resistance and vice versa. Just drop that down to bring it into your memory. What's happening in the markets? Remember, what we were looking at there was, if these levels have been broken, well then they've recently been broken, then there's no more buyers there at those markets, by buyers or sellers at those levels. So in which case, what happens is when the market comes back up and retests those levels, then there's not enough orders there to be able to allow that market to continue further. And on top of that, of course, traders see those levels and they know that those levels exist now, and of course they've now started to place orders around those levels to take advantage of this of this sort of situation. So think now how this sort of knowledge can help to increase our probability on a trade. So especially when you're thinking about we're trading in the direction of a trend and a support structure has been broken, and once that support structure has been broken, if the market then pulls back up to that sort of level again, that can then potentially become a level of resistance. And again, that can just help us to build a trading decision around a perceived turning point, a decision point in price. So I'll give you a few minutes to read through this and jot down some answers and make some notes on these points. So yeah, exactly, Nina. Yeah, so support becomes resistance in a downtrend if it's retested, and resistance becomes support in an uptrend once price has broken through it, if it comes back to retest those levels. Absolutely. Okay, well, I'll tell you what I'm going to do is, we've been running for about an hour now, so I'm going to leave this slide up. We'll take a 5-minute break, and that way we can then We can then sort of get some refreshments and to continue for the second hour. So what we'll do is we'll start back at, if I can draw on here, so if I say 20:05 London time, this is. So basically that's 5 minutes time. So we'll take a 5-minute break. We'll be back in 5 minutes. If you've got any further questions that you want to drop into the questions box over the break, that's fine. Just do that and we'll address those when we come back. And we'll be back in 5 minutes and work through the second part. So we'll speak to you in a few moments. Okay, so back now, and we shall move on now and take a look at the next section of the program. So these are good tips to sort of keep notes of these points, because they are very useful in trading, and they're also very useful for the trading strategies as well. Okay, so let's take a look now at support and resistance essential factors. Now, support and resistance is an essential factor used in both of the two trading strategies that we use through this program. So the momentum breakout strategy and the trend flow strategy. So if there is support or resistance in between our entry point and the target on either of those trading strategies, then we won't take the trade. If we think about this, this is, if we're looking for a trading opportunity, then we want to make sure that there is a free, clear space in between the trade entry and our target. It doesn't necessarily mean that the price is definitely going to get there if there's no support and resistance structure in the way, but it just means that we don't want to make sure that there's any potential complications in the way. So this sort of single factor, when applied correctly, can potentially enhance the win-loss ratio of a trading strategy. Now, we always aim for a reward to risk ratio of at least 1-to-1. So before entering a trade, it's always best to ensure that price has a clear path from entry to target before we've got equal risk reward. So what we mean by this at least 1-to-1, so if we have a distance between our entry and our stop, let's say that distance is 20 points, we want to make sure that our first target is at least 20 points away. So in other words, we're going to risk 20 points to make 20 points. We don't want to risk 20 points to make 10 points, for example. If we have a strategy that does that, then we need to make sure that it has a much higher win ratio in order to be able to be profitable over the longer course of time. So just making sure that there's no potential historical support and resistance levels in between our entry and our first target, it's just going to mean that we've got a higher probability of price reaching that level. So to identify support and resistance, it's recommended that you zoom out of the charts so that you can see as much data on the chart as possible. And always check the higher time frame charts as well. Now, what I would always recommend is, no matter what time frame you're trading on, whether you're trading on a 2-minute time frame or a 60-minute time frame or a 4-hour time frame, it's always worthwhile checking the daily charts and maybe even the weekly charts as well for major support and resistance structures in the way. So if we take a look at this chart here, we can see we've got a nice bit of price action there, and we can see that we've got a level through here that, if I get my pointer there, we can see that we've got a level through here that's been tested, well, a good 5 times there, maybe more. So it appears that the trade setup that we've got setting up here, which is just at the moment, this is a trend flow trade. So we've got, if we look at the market, we've got high highs, high lows in price action. We've got moving averages, all in the right order here, even our 200, as we can see. Price has now come back into the zone here, so we've got a small green bullish candle sitting there right in the zone. So if we take a look here, it looks like, well, the distance from here up to this level of support and resistance, or level of support that we can see here in price, is far enough away to get many targets before we reach that level. But it's always better to zoom out and take a look at as much data as possible. So if we zoom out here and take a look at the historical data, we can see that it becomes a very different picture. Now, there appears to be another level through here which is much closer to price action. We can see that there's been a level that price has tested before. It's been support, it's been resistance, it's been support, it's been resistance, it's been support, and it's just been resistance again. So now if we take a look at the trade setup that we were looking at here at Takein, we've got our little trend flow trade here. Now this level is much closer to the price action. We probably might get a one-to-one trade here by the time we then start to run into this previous support and resistance structure. So, would we still want to take that trade? So it's always worthwhile zooming out and taking a look at those higher time frames, because we're going to be able to see much more data on those higher time frames, and we just want to make sure that we're not going to be taking a trade that's going to be trading straight into a support and resistance structure that might have been there for years, or months or years, that we can't even see on the time frame that we're trading on. Now, the other thing that we need to take on board is round numbers, big psychological round numbers. Now, key support and resistance levels tend to occur around locations on charts that can often offer the astute trader with potential trading opportunities. Now, large round numbers are key, and they often have orders waiting around these levels for price to reach them. Now, orders themselves, after all, is what creates price movement. So what is a big round number? Well, in general terms, the more zeros after the number, the better the level becomes, or the more noticeable the level becomes. So, for example, parity levels, like the 1000 level that we have here, or numbers with big round numbers where we have double zeros or treble zeros after them. Big round numbers, big round levels, these are key levels that the market and other traders will be looking at. Now, these numbers, when clustering with other technical analysis, can become even more powerful. So remember to build your trading decision from as many factors as possible. So we've got an example here on Australian dollar against the Canadian dollar. Now, this is a parity level, so it's the 1000 level here. Big parity levels, are major levels on these markets. You often find that the parity level itself, being a big round number, if price has been trading around that in the past few years, you'll often find that these levels will already become known support and resistance structures, because price has traded around them, simply because it is a big round number, and price and traders have traded around this level. Now, this just creates support and resistance structures around those levels as well. So now we not only have a support and resistance structure, but we also have a big parity level, a big round number as well. So just making these levels much more stronger. But you can see on this particular market, you can see the level has been tested numerous times through here. This would be a weekly chart, so this is very high time frame, and you can see how many times this market has found support at this parity level. It's broken through it, come back and retested the level again here a couple of times. It's moved right the way down, it's come back, it's retested this level pretty much on the nose before turning around and selling off again. So, these numbers and these levels can be very important for traders to be able to understand, especially when price is coming back towards them or approaching them. Now we've also got some examples here of round numbers as support and resistance. So this one happens to be Australian dollar against the Swiss franc. So this is a 9400 level. Now this level has been tested on numerous occasions before the price finally broke down. Now round numbers can add strength to support and resistance structures regardless of the time frame that you trade. So we can see here on this particular market, we can see that this level has been tested a couple of times here. It's certainly markets found resistance coming up to this level before. It's finally broken through it. It's come back, it's retested this level, broken through it, rejected it again, tested it several times on the nose before eventually breaking through. But if we know as a trader, if we know that 9400 is a key level on this market, then it's not going to be just relevant to trading on these higher time frames. It's also going to be relevant to trading on any time frame. So even if we're trading on a 5-minute chart, we still want to know that this number and this level exists, especially when price is local to that level. So just noticing where these levels are enables us to be able to mark these in on the lower time frames if we can't see those levels on those lower time frames. So got a little bit of a practical here. We've got a bit of price action here. This market here is the Great British Pound against the New Zealand dollar. So take a look at this chart, take a look at the price scale that we have at the side here, and just consider which is the key level on this chart. So I appreciate sometimes it's not easy to be able to look at levels and unless we have the crosshairs on the Oanda charts to be able to help us look at those horizontal lines. But just take a look at this market. You should be able to see just by eyeball which levels are key levels on this market. And we've got the scale here at the side. So I'll give you a few moments just to take a look at this, and then we'll work through that. So I got some good answers coming through. So a lot of people saying around 2000, around 1.9, around 2000 again. 1.9, 2100, 2000. So we've got a lot of answers coming round around this big key level through here. And I think you're right. You know, I mean, if we start to mark in a level through here, of course, it's a much more difficult for you to be able to, you know, mark these levels in without any drawing tools. But if I mark a level through here, you see at 2000 level, which many of you have identified, big key round number here, very big round number, lots of zeros after it. We can see that the market has tested this level once here. It's tested it numerous times through here, and again here, and again here, and again here, and again through here. So, you know, been tested a number of times too. And some of you are actually saying, I think there's been a few have been saying around the 1.9 level, so just through here as well, and I agree with that. So we've got a level through here that would start about here. We've got this test here. Through here we've got support and resistance, support, and that clusters with 1900 again, another big round number as well. So just knowing that these levels are forming there in price, again, can just give us a heads up and help us with our trading decisions. So let's take a look at another chart that we've got here. So again, take a look at this one. This one happens to be dollar yen, happens to be a daily chart. So what are the key support and resistance levels on this chart? So just take a look at this and see if you can see the support and resistance structures of interest. If you identify any, then just pop those into the questions box and we'll work through them in a few moments. So we've got 97 people are coming through with, 96, the 100 level, the parity level, yep. 97's popular again. Some people are saying 98, so just around here. Some people are saying 103, just up here. So presumably sort of 103, support here, probably clusters with this level over here as well. So a lot of people coming in. I think probably the popular ones are 97, the parity level, 100, 102, we see here, 103 as well. And we've also got 98 and 96 too. So there's certainly a number of levels that we can see through this piece of price action. And we're just looking at the daily chart here, so we can do exactly the same on the weekly chart as well. So let's just see what we've marked in here. So there's certainly some key levels around these numbers. So 97, which a lot of people identified, it's been tested pretty precisely a number of times. Just look at how precisely this has been tested through time. We got the 100 level here, the parity level, which again has been tested pretty precisely right the way through, going back to some years back here. We've got the 1.10150 again, which has been support, resistance, support, possibly support again, and 1.3 or just above 1.3, 1.330, just through here again has been support and resistance. So again, just note, you can see how price tends to respect those levels that they've created and tested in the past. So if we know that price is coming back up to a level that has been tested in the past, then we might expect some sort of reaction around price. So just, it doesn't mean to say that there's always going to be a trading opportunity at these levels, but it means that we might expect a reaction which could support our trading decision. So we've got another bit of text for you. So just a time to be able to take a screenshot of this particular slide using the camera in the top bar, and again, just give you a few moments here, give you 5 minutes just to be able to jot down your answers to these points. So why might big numbers act as support and resistance? Who's placing orders there? Now, a lot of the big fundamental traders, they tend to just place orders and place sort of targets around big numbers. So they're more looking at taking advantage of the bigger move. So they'll look for markets to move from one area to another area as a fundamental structure change. They're not necessarily interested in the sort of shorter term ebbs and flows of the market that we as intraday and sort of short term swing trading day traders might look to do. So they tend to place their orders around those big numbers, around those big sort of psychological numbers. And you have many orders sitting around those numbers across the world. Well, of course, price tends to react when it approaches them. Flat level support and resistance is an essential factor in the momentum breakout trade. Why is that? I mean, that's simply because with the momentum breakout trade, what we're looking for is those flat levels of true support and true resistance to look for trading opportunities around. So we're looking at trading the breaks of those levels in conjunction or in the direction of the prevailing trend. But we've got to be able to identify those levels before we can even build a trading decision around them. So how might support and resistance back up a trend flow trade? Well, of course, with a trend flow, what we're looking at doing is we're looking at trading in the direction of the trend. We're looking at trading trading a pullback and looking for a more of a lower risk entry opportunity as price pulls back within the trend. So if we've got a price action, a trend where price is pulling back into a support and resistance structure within the context of a trend, well then of course that can really help us to be able to identify a potential turning point within the market. And remember to remind yourself why it's always wise to be able to zoom out of the charts and take a look at the higher time frames and look at as much data as you can before placing that trade. Take a look at those higher time frames, look at the structure of the markets to make sure that there's no historical support and resistance in the way of price action, just like we tried to demonstrate earlier on. Sometimes there could be a historical support and resistance level which we just can't see on lower time frames or on the local near-term price action. But as we've seen with some of the charts this evening, price does respect those levels for years in the years to come. So it's always worthwhile knowing where they are and where they exist. Okay, so let's move on. And we've got two trade opportunities here, or two pieces of price action. We've got trade A and trade B. So to consider what your trading plan might be with trade A and trade B. Again, I'll give you a few moments just to take a think about this, and then we'll start to take a look through it. So think about what we've been looking at with support and resistance structures. Think about how that might help with what we're looking at here on the trend structure here on trade A and trade B. So if we take a look here at trade A, if I get what we can see is we've got a nice trend here to the long side. So we've got higher highs, higher lows. We've got moving averages all fanning in the right order. So we've got a nice uptrend here in price. Nice moving average geometry, nice space in between the moving averages. They're all in the right order as well. And the price action, if we take a look at the size of the candles, it's all nice sort of steady, steady flowing candles. There's no sort of extremes of buying or selling there. And if we take a look at this a little bit more carefully, we can see the level through here, that price, if I can highlight that level, not a very straight line, but if you can see that level that price has tested a number of times. So price has come up, it's tested it once, we've then come down, we've made a higher low again. We've then got an equal high, again a higher low, an equal high again, and a higher low. And at this point, we're just coming back up and testing that level again. So you might think, knowing that we've got this flat level through here in price, we could start to think about utilizing a possible momentum breakout trade on this flat level, where we'd be looking at trading this opportunity, taking a trade on this market to the long side if this level was broken, possibly stop underneath the swing low here, trading it in the direction of the prevailing trend to the long side. So yes, I mean, some questions has come through. You'd like to see the price actually coming back into the moving averages. Remember, what we're looking at here is each time the prices, it has pulled back into the averages here. It's pulled back into the 20 here, actually. It's pulled back into the 20 here too. At this point here, we have got this level, resistance level through here. And the price is just right underneath, or the moving averages are just right underneath the price action. So there's not an awful lot of wiggle room there for price to move around. If we take a look at this area back here, well, at this area here, price was overextended from the moving averages, so we got a pullback into the zone. You know, at this area here, where we had the high, well, not quite so extended, but we did have room for it to pull back. At this area here, probably not much room at all to actually pull back. So we'll be looking at that sort of compression situation, with price compressing up against that level, looking for that pressure to burst as the price breaks through it. If we take a look at trade B, then we can see that we've got the context of a downtrend here. We've got, again, all of our moving averages in the right order. We've got, at this point here, if I can draw a level through here fairly straight, so not too bad freehand. So the market here was quite overextended from the moving averages. So it's expected that price was to trade sideways or to have a pullback into the sell zone. So we've kind of had that. The price has sort of pulled back, not quite made it to the averages here. It's then come down, it's made an equal low. It's then come up, it's tested the 10 period here. It's actually made a lower high. So if we actually made, if I can draw that there, lower highs through here too. Nice small candles as price is compressing here. So we could be looking at this as a possible momentum breakout opportunity as price breaks through this flat level, looking for opportunities to the short side. So this is how we can utilize flat levels in price action for possible trading opportunities. Bearing in mind at this moment in time we haven't even looked at all of the strategy rules and all of the different techniques that we need to see setting up all at the same time. Okay, so let's take a look now at the next one. So we've got a piece of price action here. This is a momentum breakout opportunity to the short side with support and resistance back up. So consider the various ways in which support and resistance can add strength to a potential short trade. So see what we've got here. We've got an initial downtrend. We've got a flat level with at least 2 touches. So once we have 2 touches, let's get my pointer back there. So we've got 1 test here, we've got 2 tests here, or we certainly got maybe 1 test, 2 tests, we certainly got by here, we've got 3 tests. So now we know that this flat level is a level of true support. We've then got further tests of this support structure, just adding, making this level that much more stronger. If we look a little bit more closely, we can see that there is another level through here formed just above price action. Now, this can help add further protection for our stop. So if we were looking at a trading opportunity to the short side, for instance, then we could be looking at a break below this level, trading it in the direction of the trend to the short side, with a stop behind the swing high here. We see that that's been tested a couple of times, so now we've got a level of true resistance protecting our stop. So it's just examples of how these support and resistance structures can start to help us with building our trading plan. Okay, so let's take a look at the next piece of technical analysis that we're going to discuss this evening. We're going to look at candles, or more specifically, candles TWP style. Now, rather than studying all the key characteristics of candles, that traders often fall into this trap of trying to memorize all the different names and the candle patterns. Now, the trouble is that depending upon which book or which sort of video or seminar that you've looked at, you're going to have a different number of candle patterns and candle names, and there can be many of them, 40 or 50 of them, maybe even more. And the trouble is, when you start to then look at the charts and you're trying to remember all of these different candle names and the candle patterns, and which one that is, and have I got that named correctly, and then what does it mean? It becomes very distracting. By the time you've worked that out, well, the price has moved on and it's formed another candle, so it becomes irrelevant. Now, candles can be very important, and they can give us a lot of information to help us with our trading. But the important things to understand is really what's happening behind price, the sorts of things that the psychology behind the markets. And candles can be a very good way of telling us this, but we don't need to know all the different names and all the different styles. But what we do need to know is whether the candle is telling us whether it's bullish, bearish, or indecisive. So what helps us in trading is pinpointing who's in charge, the buyers or the sellers, or just as equally identifying when there's no clear winner. So let's take a look at some candle styles here. So we've got some bullish candles here. Now, we've got some various names here. We've got, they can be called a long day, a hangman, a hammer, and a dragonfly doji. We've got some short candles here, some bearish candles. Again, they can be called, inverted hammer, shooting stars, graveyard doji, and we've also have a number of indecisive candles, which like Hirami doji, long-legged doji, a short day, a spinning top, and all sorts of different names. But the important part is we don't have to worry about what the names are. That's not really going to help us with our trading. But understanding what they mean and what they represent will. So as we can see here, we've got bullish candles, a number of bullish candles, and they all mean the same thing. The buyers are in charge of the market. With all of these candles here, it's just indicating that these are bullish candles. Lower prices have been rejected in the markets on this timestamp of candle. So if lower prices have been rejected, well, the path of least resistance for the next move is going to be to the long side. Likewise, on this set of candles here, these are all bearish candles. If higher prices have been rejected in price on the timestamp of this candle, well, the next one is, well, the path of least resistance is certainly going to be to the short side, and that can really help us with our trading decisions. Now, likewise, these candles can as well. Now these ones are all indecisive candles. So you find that indecisive candles are typically sort of smaller in size and normally have a very narrow body, if any kind of body at all. Now these can really help us to understand that there's, well, no clear winner in the markets at this particular time. And they can be useful for a number of reasons that we'll come on to shortly. So some key characteristics of candles. There's 4 characteristics of a candlestick which can provide a wealth of information individually. The first is its color. So typically you tend to find that bullish candles are green and bearish candles are red. Some charting packages, if you use a different charting package, enables you to color the candles in a different way, but generally speaking they tend to be green or red. Now the candle size as well can give us a lot of information on what's happening within the market. You know, if it's a big candle or a small candle. The location and the size of the candle's wick or shadow, or in other words the tail, that's the little line that runs along the top and on the bottom of the candle. The size of that tail and the location of the tail, whether it's on top of the candle or on the bottom of the candle, again can give us a lot of information as to what's happening behind price action. Now the candle's location within the trend and the relationship to the moving averages as well can then start to help us with building and complementing the other technical analysis that we use in the markets. So try to understand the story of the candles on what they're telling us rather than remembering just their names. So let's take a look at the first one here, which was the size. So does the size matter? Well, small candles usually form before a move occurs, and they can provide an early suggestion of a price move. Now large candles often occur when amateurs are jumping into the markets that's reaching the end of its run after the move has already happened, in other words. Now that's normally the time when the pros are starting to sell out. So the tip here is to stay away from big candles. It's always much better to be getting in at the beginning of the move than rather trying to scrape a few pips out of a move that's starting to run out of steam. So this explains why many new traders often feel like the market is out to get them. Of course it's not. The market can't see you, it doesn't know you, it doesn't know you from anybody else. But the pros know what they are doing and they take advantage. So small candles are a vital ingredient to TWP's trading strategies. We don't want to get in at the start or the end of the move. We want to make sure that we take advantage of that move in price action. So we want to make sure that we get in at the right place, and small candles can help us with this. So what does small mean, and how do you best judge whether a candle is small or not? Now this is the difficult part. Small doesn't refer to a certain pip or tick size. Remember that the strategies that we use are universal. They can be used on daily time frames, they can be used on weekly time frames, and on 5-minute charts and 10-minute charts, and every other time frame in between. So what it means is, it means small in comparison to the candles around it, and that are typical for that particular instrument and that particular market. So this can only really be determined by a visual check on the charts. Now a basic non-scientific definition of a small candle is that an average or below average size, but definitely not a big candle. So let's take a look at a chart here. and we'll try and explain exactly what we mean here by small candles. So if we take a look at this market here, we can see that we've got a lovely trend in the market, nice clear series of higher highs and higher lows. We can see that we've highlighted here a number of candles where we've got nice small candles within the context of the trend. But notice how we've got small candles before the big move, small candles before the big move, small candles before the big move. And you can see this happening all of the time, consistently through this market. So consider, which candles would you rather trade around, the small ones or the big ones? So let's take a look at some small candles in the buy zone here. So we can see we've got a nice trend here in the market, nice consistent higher highs and higher lows, moving averages all in the right order. As the price comes back into the buy zone here, we get small candles before the big move, small candles before the big move, small candles. This is the time when we want to start utilizing our trading strategy and utilizing the rules in our trading strategy to look for opportunities using small candles. See another one here, small candles back in the buy zone, small candles before the next move occurs. So you can see how many times this is happening. Now, small candles in the buy zone are an essential factor for the trend flow trading strategy. It's exactly the same for a trend flow strategy to the short side as well. We look for these small candles, in that case, in the sell zone. So we look at some examples here, small candles in the sell zone. We've got a downtrend here in price, moving averages flowing in the right order here, price coming back into the moving averages, small candles before selling off again. Same here again, price coming back into the moving averages, small candles before the market sells off. So we get big candles on the move down, pulls back, then we get small indecision candles before the next move to the short side. So the wicks on the candles, I mean, some of these looking at, so some questions on the wicks of some of these candles. I mean, if you look at this candle here, it's got a wick on the top of the candle, certainly suggesting that that is a bit of a bearish candle, but we're expecting it a bearish candle, and it is a red candle too. You know, again, that we have here, what we're looking at the moment is the candles. So not necessarily, try not to confuse the strategy with what we're looking at here at the analysis at this moment in time, because what we're going to do when we give you the strategy rules will be very, very specific. At this moment in time, what we're trying to do is to just understand the actual technique and the strategy here. I mean, we've got a bearish candle. Well, both of these candles look a bit bearish because they've got long wicks on the top of them. One's a green candle, admittedly, and one's a red candle. But when we come to the trading strategy, it will be very decisive over which candle and what type of candle we need to consider as part of that strategy rules. So, you know, we will, in that case, we would use the red candle. So, you know, but we will give you those once we've covered all of the technical analysis. So if we take a look here at small candles before a breakout, so you can see we've got a piece of price action here, predominant downtrend. The market's come down, it's tested this level once, tested it twice, tested it 3 times, tested it 4 times. So after 2 tests, we've now got a level of true support that's been formed in the markets. We can then see that we've got another further number of tests that have now created at the same level. We've also got small candles that are forming just above the flat level, just before price breaks through. So this is just a classic example of a breakout in the predominant downtrend. You've got small candles are a bonus point for this trading strategy. And you can see how we've got small candles. Well, all the way through here, we've got small candles before a big sell-off to the short side. So what we also have here is big candles ending moves. So if we just sort of see here, with this sort of price action, we can see where the professionals are trading and where the amateurs are trading. We often find that small candles are indicative of professionals acquiring a position in the markets. These are normally when professionals come into the markets, they need to acquire a large number of contracts, and they can't just buy their large number of contracts at the market because they will push the price away from them and they'll end up getting in at a worse price. So often what they tend to do is to just soak up the available price action at a certain level or within a certain small range in order to be able to acquire the number of contracts that they want. And this sort of buying activity or selling activity creates small candles. So we can see we've got small candles before a big move, small candles before a big move, small candles before a big move, and you can just see it all of the time. In the uptrend, you can see it again, small candles before a big move, and you can see it time and time again, the same situation. So just knowing this can really help us get an indication of what's happening behind the markets. And think about where you would like to be trading. Would you like to be trading with the small candles or with the big candles? So we take a look at this piece of price action here, and we see what's actually happening through the piece of price, through this market. We start to consider, who was buying the market here with these small candles. Then who was buying here when we had big candles and it started to run out of steam? Who bought here when the market ran up and we had big candles? Who was selling here when the market came back into the averages? And who sold the market down here where we've had this big sell-off and now big erratic candles to the short side? So we can start to give us an indication of who's in control of the markets. Now, one thing with candles is the shadow important? Or in other words, the shadow, it means the wick or the tail, as we can see here. Now, the location and the length of the shadow is very important, as it shows that the market has rejected a move to change direction. For example, it rejects the original direction. So this candle can be important. It's a bullish candle or a bearish candle. If we take a look at this candle here, we can see that we've got a big wick on the bottom or a big tail on the bottom of the candle. So at some point in this timestamp of this candle, the market has tried to come down. The price has tried to make lower prices down here. The market's rejected all of these lower prices, pushed price right the way up past its open, and it's closed at the high. Just meaning if all this lower prices have been rejected in the market, well, the path of least resistance is more likely to be to the long side now. And it's exactly the opposite here for the opposite candle, in which case lower prices are likely to be more predominant for the next move. So then we have bearish to indecisive candles, which equals a bullish. So bullish indication following a lower move is confirmed only if the subsequent candles break the high before breaking the low. So we can see here that we've got, a candle in a downtrend. We've got a sort of bearish candle here, but we've got big wicks on the candles. We can then see that we've got sort of indecisive candles. But if the subsequent candles break the high before breaking the low, then this can indicate a bullish indication. So for example, we've got a downtrend here, as you can see in all of these examples. We've got a downtrend, then we've got our indecisive candle here, our small indecisive candle. So if the next move, in other words, breaks the high of these candles, then it makes these indecisive candles bullish. So it confirms that we've got an indecision in the markets, possibly a bit of a turnaround in price, possibly. But only if the high is broken before the low. So exactly the opposite works here for an indecision candle. A bullish to indecision candle could mean a possible bearish signal. So again, what we have here is we've got an up market here. We've then got small indecision candles. Again, with this, up market, small indecision candle. The next move has been to break the low and continue lower, and exactly the same here. So it's just indicating that this is an indecision candle. It's indecision in the continuation of this trend, and the market has now retraced. Now, it doesn't necessarily mean to say that this is a downtrend, going to be a long-term downtrend. This could just be a pullback within the context of the trend. So, but it means that we've got a bit of selling action that is now, or the bias has now come back in to be a selling bias in this market. So, indisputable bullish and bearish candles. So we've got some examples here of bullish candles, and we've got some examples here of good classic bearish candles. So if you think about these candles and think about what's happening in price, so you can think about then when you see these in the market, who's in control? So just taking a look at all of these candles here, we've got typical up candles where the market's opened at the low, closed at the high. We've got candles here with a big body on them where the price has moved from one level to the higher level, and we've got small wicks on the top and the bottom. We've got other candles here where we've got a big tail on the bottom, like this one here, even bigger tail, where the market has tested lower prices. These lower prices have failed to hold, and the market has pushed up right the way through the open and closed at the very high. And then of course we've got this candle here, which is, although it's it's what's known as a doji candle, it's opened and closed at the same level. The market is bullish because the market has tested these lower prices, and these lower prices have been rejected, just indicating on all of these candles that lower prices have been rejected. The next path of least resistance for the next candle is likely to be to the long side. Now it's just exactly the opposite here for these bearish candles. If the path of least resistance, or the higher prices I should say, have been rejected in price on this timestamp, well then the next candle is likely, or the path of least resistance for the next candle is going to be to the short side. So let me just tell you a little bit more about the next sections in the Forward Thinking Traders program. So we hope that you've enjoyed the content that we've covered in part 2. Now in part 3 which we're running next week, same time. Part 3 we call Understanding the Bigger Picture. So in part 3 we're using convergence between price and indicators to assess the probability of a trend continuing. We also look at accurately assessing divergence to spot a potential trend reversal. Now this is a technique how we use some traditional technical indicators in unconventional ways to read or get an understanding of future price action. We then tie the technical ingredients together with the bigger picture to view essentially multiple time frames and build our trading decisions across multiple different time frames for that market. So then part 4, we then call that precision trading strategies. So in the part 4 we would have actually gone through all of the technical trading techniques that we're going to use for the 2 strategies. So we'll then go into the strategy detail itself. So there's 2 strategies, trend flow strategy and momentum breakout strategy. So we'll give you the complete recipes that combine all of the techniques and how we use the techniques together, and then we'll give you an understanding of the elements of each strategy and develop a detailed checklist that enables you to identify potential trading opportunities ahead of time. So if you'd like to join us on the next part of the programs, be sure to register at Awanda. So you need to make sure that you have those links. Just because you've attended this